Private credit and shadow banking are starting to implode, and we've got the regional banks showing huge signs of stress due to fraud, of all things. And now we've got the repo market waving these huge red flags, giving us warnings that something is not right in the financial system. I'm going to explain exactly what's going on, and I'm going to give you my opinion as to if I think this is the canary in the coal mine, if this is a sign of a potential credit crisis coming our way in 3 simple fast steps. Step number 1, let's go over what exactly has been happening in the repo market itself. Most of you know what happened in September 2019. Editor, go ahead and throw up a chart. The repo rate spiked up to almost 10%, and the Fed had to step in because if they wouldn't have, the entire monetary system, the financial system, could have just collapsed like a house of cards. So let's start by looking at this chart from today's date, roughly going back to September 1st. On the left, we go from 3.8% up to 4.6. The blue line is SOFR, which is basically an interest rate that's derived from transactions in the repo market. And the red line is FFR, the effective Fed funds rate. So this is basically a proxy for interbank lending. Okay, now you'll see this red line pretty flat here. And then it drops down. Why on earth did it drop down? That's right. That's when the Fed dropped rates. So the Fed drops rates, the FFR comes down, and SOFR comes down as well. But it's kind of hovering about, maybe call it 3-4 basis points above this red line. But you see these spikes here, a spike here, and a spike here. Now I think more recently it's come down, but you'll notice these periodic spikes. So the question we have to ask is this just a representation of kind of imbalances in the system that you would expect to see at the end of the month or the end of the quarter, or what a lot of people are pointing to, and they're saying, okay, well, this October 13th is not the end of the quarter, so nothing really explains this spread, so it has to be due to a lack of liquidity or a lack of cash. And well, the Fed is doing QT, so they're going to have to slow down QT or actually start quantitative easing to pump the system full of bank reserves or liquidity or cash, and that's what's going to bring this spread back down to, let's just say, normal levels. But there is another reason this could be happening. It could be a result of increased counterparty risk. So let's think this through. If you are a lender in the repo market and you have a counterparty come to you that has a triple F rating and you think they could go bust tomorrow, are you going to charge them a higher rate or a lower rate? Most likely you're going to charge them a higher rate even if that loan is collateralized, because there is a chance that that entity could go bust, or they could just not give you the collateral. They might not be good for it. And let's remember, most of this collateral is rehypothecated several times. More on that in step number 2. Now, before we move on, I want to be very clear. This spike that we're seeing here, most professionals agree that it is abnormal. Where some of the spikes, like maybe this one, or editor, go ahead and throw up a long-term chart. We can see these spikes happen all the time. But what most professionals agree on right now with this most recent spike is it is happening at a time when it shouldn't happen. That's really one of the key takeaways here. So then the discrepancy or the difference of opinion is really about why this is happening at an abnormal time. Now let's go over a very simple example or analogy so all of you understand exactly what's happening here. So imagine I just came to you and said, okay, we're going to play a little game. A car has stopped, but that's all the information I give you. And I say, tell me why the car stopped. Now, the car stops, again, looking at a long-term chart, it stops all the time. Just like you have these spikes all the time. But it could be stopping for a variety of reasons, right? So as an example, the car could stop because it came to a stop sign or a red light. And this would be very, very benign. Nothing to worry about. Or the car could stop because it just parked at Walmart. It's just going inside to pick up a few things. Again, benign, not something we should worry about. But the car could have stopped because it crashed into a brick wall. And this is something that we actually should worry about. So if you were trying to decipher why this car stopped, what you would need is more information. You would want to see if there were any skid marks. You would want to see if there were any other cars that just happened to stop at the exact same time in the exact same spot. You'd want to see if there are any dead animals on the road. You would want to see if maybe there were any broken brick walls or reports of a car hitting a house or something like that. So you'd have to kind of put on your CSI hat and do a little bit of homework and do a little bit of research so you could determine the probabilities of the car stopping as a result of something that we really shouldn't worry about, or the car stopping as a result of something we should really be worried about. And of course, that would be the system, the financial system, starting to break. So the point here is the car did stop right there. And it was probably a stop sign. The car stopped right here. And it was probably just because it parked. And the car stopped right here. But this is the big question mark where we've got to put on our CSI hat, and that's exactly what we're going to do right now. Step number 2, check out this recent headline from Reuters. U.S. banks tap Fed repo facility as overnight rates climb, signaling funding strain. Now, to be clear, we're not talking about the repo market. We're talking about the Fed's repo facility. So this begs the question, okay, well, why on earth would an entity go to the Fed for a repo transaction or a repo type transaction when they could just use the market? And maybe, just maybe, it's because they can't get a rate that is acceptable at the market because the market sees them as too risky a counterparty. See, when the Fed does a repo transaction or does any transaction with a counterparty, they don't assess their balance sheet. They don't assess the level of risk. It's just the real repo market that actually has to think about counterparty risk. And check this out. U.S. banks borrowed $6.5 billion from the Fed's standing repo facility on Wednesday, and that was the biggest daily borrowing from the Fed since the cerveza sickness, excluding the end of quarter periods. Again, what are the end of quarter periods? That's when the car is coming to a stop as a result of a stop sign and not a brick wall. The article goes on to say the SFR acts as a liquidity backstop for potential funding shortfalls. But why are there funding shortfalls? Is it because the lenders in the repo market just don't have any money? They don't have any cash? This doesn't make a lot of sense to me because most of them are banks, and banks create cash. So how can they run out of something that they actually create? More on that in step number 3. But let's get back to the article. Introduced in July 2021 in response to the cerveza sickness, the Fed's facility provides twice daily overnight cash loans in exchange for eligible collateral. And that's another thing. This could be a collateral issue with those high-risk entities. They don't have the pristine collateral like treasuries. So if they go into the actual repo market, they're going to be charged a sky-high rate where they could go to the Fed and they're charged a lower rate for collateral that is lower quality. And here's another key that's really important to pay attention to. They say the rise in the repo was unusual, traders said, given that it is not month end or quarter end, when repo rates tend to jump as banks pull away from acting as middlemen due to higher balance sheet costs required at those times for reporting purposes. And here's a quote. This is just one more sign that liquidity is slowly but surely decreasing. So again, is it a question of liquidity drying up because there's just no cash? Or is it because counterparty risk is going straight up? And here's something else that we've really got to pay attention to. The U.S. Treasury has been aggressively issuing shorter-term debt, hitting record levels in the past few weeks as it tries to reduce borrowing of long-term debt and bring down yields on that part of the curve. Really? Because the curve is pretty flat. So when I see this, I don't think about, oh, well, this is just an issuance type of deal. I think that the U.S. Treasury is issuing much more at the front end of the curve, in other words, bills, because they know that there's a shortage of collateral. Or, well, why would there be a shortage of good types of collateral where these counterparties wouldn't have to take a massive haircut that in and of itself could blow a hole in their balance sheet? It's because counterparty risk goes up. Just put yourself in the shoes of a lender. Let's just say that you've got all the cash that you could want to make any loan as long as the risk reward made sense. And you've got one guy coming to you that's a AAA credit rating, and you say, okay, we'll go ahead and charge you 4.3%, something like that. And you have a treasury. Oh, that's fantastic. That's great collateral. And then you've got Garbage Corporation that comes in with a triple F rating and says, yeah, we want the same loan. And we've got a treasury. You're going to look at them and say, okay, it's good collateral, but I don't even know that you're going to give me the collateral. You could have rehypothecated that 20 times, or that could be a rehypothecated treasury that you're pledging to me. So I'm not going to charge you what I just charged this last guy. I'm going to charge you maybe 10, 15 basis points more. And what we have to realize is the repo rate is just simply an average of all the transactions for the entire day. A lot of people think that, well, if the repo rate is, just to say 4.1, then every single entity got that rate over the day. That's not how it works. The entities could have got 5%. Some entities could have got 3.8%. That is just an average. So if the average spikes, what this is telling you is that there's a lot more garbage corporations that are coming to the table wanting that loan, and the lender is sitting there saying, either one, we're going to charge you a lot more, or number two, we're going to need a lot more collateral because you're a higher risk. And if there's more collateral needed because the risk goes up, then the Treasury is going to have to issue more of that collateral, and that would be T-bills, in other words, treasuries at the front end of the curve. Exactly what they're doing. But now let's go over what is happening with the regional banks. And we thought that we were done with this, right? In March of 2023 when the Fed came out with the BTFP. But they just kicked the can down the road. Check this out. Title of this article: The Tide Went Out, How a String of Bad Loans Has Bank Investors Hunting for Hidden Risks. Hidden risks. So what I've got highlighted here pretty much summarizes what's going on. Regional bank Zion late Wednesday disclosed a near total wipeout of $60 million in loans after finding apparent misrepresentations from borrowers. So what was happening is these borrowers that were buying commercial real estate of all things were saying, okay, bank, go ahead and give me a loan for $50 million. And as collateral, we're going to pledge to you this building. So if we default on the loan, you can go ahead, take ownership of this building, you can foreclose, and then you can sell that and get your money back. So Zion looks at that, hey, it's a collateralized loan, it makes sense, I'm going to go ahead and do the deal. But what they didn't realize is a lot of the borrowers were taking that one piece of collateral and pledging it to multiple banks. Multiple banks. So if, or maybe when, they go bust and they can't pay back the loan because they're buying risky assets to begin with, then all these banks that they borrowed money from just basically get the old rug pull. But it wasn't just Zion. Check this out. The next day, Pure Western Alliance said that it had sued the same borrower for pretty much the exact same reason, and they alleged fraud. So where there's smoke, there's fire. And this is why Jamie Dimon the other day said, when you see one cockroach, there's probably a lot more that you don't see. So this is the first, or not the first, this is probably the third, fourth, or fifth cockroach, meaning we saw Tricolor, we saw First Brands. I'm sure you guys followed that story. That company completely blew up. And why? because they were doing the exact same thing. They're pulling these shenanigans with collateral. So we haven't just seen one cockroach, we've seen like 5 or 6. So you have to make the decision. What are the probabilities that there's only 6 cockroaches versus what are the probabilities that there's hundreds, maybe thousands of cockroaches that when you fumigate will come up to the proverbial surface? So the next question becomes, do I think, based on everything we've discussed in this video, that we are starting to see the breakdown of the entire financial system? I'm going to answer that question for you right now. Step number 3, the boom, bust, and bailout economy that we have created in the United States. So let's do a quick review here. We've got a few options based on what's happening. We'll start with the repo market. Is this normal as far as the spread that we're seeing between the SOFR rate and the Fed funds rate, or the effective Fed funds rate, or is it abnormal? Well, this one is pretty easy based on everything that we discussed, especially in step number 2. And oh, by the way, one thing I didn't add is even Bank of America has come out and said that because of this additional credit risk we are seeing in the system, they're saying there's a decent probability that we actually have a stock market crash. And that's according to Bank of America, not just George Gammon. So I think you can say very safely that what we're seeing right now in the repo market is abnormal. This is not normal, although there has been many times in the past where you have seen this type of spike. Again, we have to ask the question, why is the car stopping? So now that we've established that it's most likely abnormal, we can say, okay, is this a result of the risk increasing or a lack of bank reserves? I think this is also an easy question to answer because the banks make money. They create money, or dollar credit, dollar denominated deposit liabilities, whatever you want to call them. What we use as money or cash, the banks create this by lending it into existence. So there is no constraint on the amount of money they can create by lending if the risk reward actually makes sense. They don't need bank reserves or the Federal Reserve to do that. They don't need it to create the loan, nor do they need it for interbank settlement. And if you don't believe me, just go ahead and look at a chart of the amount of bank reserves in the system. Editor, help me out with that one. And we can see that prior to QE, there were almost no reserves in the system. But believe it or not, we didn't have any repo blowups back then like we did in September of 2019. Why? Because the banks were creating plenty of liquidity because perceived counterparty risk was low. So the bottom line is I think we can also safely say that if this spike in repo was abnormal, that it's most likely a result of increased risk. And if you didn't watch step number 2, I would go back and review that, and I think you will come to a very similar conclusion. So then we move on down to this question. What is my base case? Do I think what we're seeing right now is the financial system starting to break? And the answer might surprise you. It's actually no. Why do I say that? Let's go back to this timeline that I tried to create, and this is just out of my imagination. This is not a copy of a chart or anything like that. And we go back to the late 1990s, LTCM, long-term capital management. This was the bailout that the Fed basically orchestrated. And then we go, notice it's going down, you'll see why in a moment. We go to the next, let's just say central planning bailout of the system was a GFC. Then we go to the repo blowup, September 2019. Then we go to cerveza sickness, where the Federal Reserve actually had to buy shares or buy corporate debt through these special purpose vehicles, completely against the Federal Reserve Act. And then we go to March of 2023. Remember the BTFP? So what happens next? I don't know, but I'm sure there will be a next. And you notice how we're having a gradual decline that gets more severe every single time we get one of these bailouts of the financial system. Well, why is that? That brings me to the red line. The red line, this is why I kind of see it in my mind, is a representation of economic distortions created by these bailouts themselves. And you'll notice it's a mirror image of the black line. So each bailout that we have creates more economic distortions. And the economic distortions are more severe with every single bailout, to the point where this probably goes straight down while this goes straight up. Why are these economic distortions so important? Well, we're going to get into that in just a moment. But another analogy, going back to the car stopping example that we gave earlier, is what we're trying to figure out here is whether or not this car has been stopping as a result of coming to a stop sign or hitting a brick wall. But my point is, it really doesn't matter as far as the financial system itself breaking. Why? Because the financial system already broke. You see, in free market capitalism, and this includes the monetary system, this includes the financial system, the loss is just as important as the profit. And if we don't allow entities to fail, what we're going to do is we're going to create this moral hazard. This moral hazard, among many other things, creates a lot of what we have seen in the United States that is getting worse and worse and worse. For those of you who are my age, or almost my age, let's think back to the 1990s. And let's ask ourselves, how bad was the homeless situation back then? How bad was the drug situation back then? What was the standard of living like? How about the social unrest? For any of you watching this video right now that can remember back to that time, I'm sure you would agree with me that all these things have gotten worse. Why have they gotten worse? In my view, it's because of the economic distortions. This is the key. And the economic distortions, ironically, were created by the central planners themselves, trying to keep the system from breaking. But the irony is, by them trying to prevent the system from breaking, they actually broke it and are making it much, much worse with every single bailout. So the boom cycle gets bigger, the bust cycle gets maybe less, the bailout cycle gets even more, but the price that has to be paid is unfortunately paid by society, and the burden is disproportionately on the shoulders of the poor and middle class. So the main takeaway here is, my view is, the system is not breaking because it's already broke. And whether or not this is a stop sign or we're hitting a brick wall doesn't even matter. Because if we hit that brick wall, the central planners are just going to come in with more bailouts, more economic distortions that allow us to go ahead. They just piece the car together with duct tape and spit, which allows us to hit another wall. But every single wall we hit, the car gets worse and worse and worse. And it's the exact same thing with not only the economy, but more importantly, the standard of living, which leads to social unrest. Now, I know a lot of you right about now are saying to yourself, okay, George, I get it. We're in some very precarious times. And this doesn't even include the fact that the stock market's in a bubble. We're in a big AI bubble. We're in a housing bubble, pretty much an everything bubble as well. But how do you protect yourself? How do you hopefully even grow your wealth through these tumultuous, volatile times we're living in right now? Well, I've got good news for you. I'm doing a webinar October 29th. It is totally free. And I'm going to be going over 3 contrarian strategies that the pros use to actually invest during financial bubbles. And I can assure you, it isn't buy and hold, it isn't buying the dip, and it definitely is not buying an S&P 500 passive index fund. And the huge bonus to you is just for attending, I'm going to give you a coupon code for $500 off Rebel Capitalist Live, which is my investment conference, in 2026. This will take the price of the ticket all the way down to 99 bucks. You've got absolutely nothing to lose and everything to gain. So if you want to participate in that free webinar, October 29th, we'll go ahead and put a link in the description below. Click that link and you can register.